What's going on, everyone? It's Steven. I got an awesome video for you guys today. Recently, a lot of people have been reaching out to me. They say, hey, Steven, you're talking all the time about what some of the top 1% of investors are doing and how you use their strategies. What are some of those strategies? What are those top 1% of investors doing that you're doing and that I might not be doing? Can you fill me in on some of that stuff? And it's interesting. The video that we're talking about today is quite interesting, right? In the news, on CNBC, on the internet, in financial media, they love to talk about when stocks go down and when they go down big. And the term they use when they talk about those stocks going down and down big is a falling knife. Do you want to catch a falling knife? Do you want to just leave it there and have someone else take a stab at it, right? So one of the things that the pros do is that they know exactly how to deal with a stock that's a falling knife. Now, I'm not going to tell you exactly what it is now. I want you to watch the video because there's a lot of really useful and actionable information in there. But when a pro sees a stock that's in free fall, that's a falling knife, a pro, they know exactly what to do. Exactly what to do every single time. So, thank you for showing up to this video. It's going to be super informative, but most importantly, it's going to be super actionable. The way the top 1% of investors deal with these falling knife stocks, these stocks that are selling off hard, you're going to know exactly what they do and exactly how to implement the strategies that they use. So thank you guys for tuning in. Let me know if you have any questions below, and I'll see you inside the computer. Okay, everyone, we are back inside of the computer. And we're talking about how to invest like a pro. And the question I've gotten from readers, the question I've gotten from emails from some of my Market Hero students is, should we catch a falling knife? Now, this is just something that, if it works out, can be an addition to your portfolio, to your strategies, to your outlook. And if it doesn't work out, this would be a great thing to add to the list of do not do's. And the reality is, the more you guys invest, the more you guys trade, the more you guys watch these videos, the more you guys learn, the more of an understanding you're going to have of what these things do and how it can incorporate all these different things into your investment strategies. But the reality is, and the question I have for you today, and kind of this funny image that I have here on the right side of the screen, that's myself looking confused, is, how are you really going to grow your account without some sort of a game plan? And you should ask yourself that, really, if you're really looking to grow your account, if you're really looking to create big time wealth, which is possible, very possible over time. I've seen it for myself. I've seen it for some of my students. How are you really going to grow your account? How are you really going to create wealth over time if you really don't have a game plan? If you're just going out there willy-nilly, how are you actually going to do that? And this concept of catching a falling knife, the pros know what to do when a stock is in free fall, right? The concept of catching a falling knife. The pros know exactly how to trade it to maximize profits. They know how to do it so that no matter what stock it is out there, if a stock is in free fall, if it's a falling knife, they know whether to stay away or to get involved. And that's the plan here. That's what we're going to show you. So you can add this to your game plan so that ultimately you guys can either make money if it is the right thing to do, or prevent yourself from losing money if it's not the right thing to do. And then within the next few minutes, you're going to learn if it is the right thing to do or not. So what is a falling knife? Now, bear with me with the quality of this photo. But this is a stock that actually doesn't trade anymore. The company went bankrupt, called Sun Edison. The symbol SUNE, SUNY. And you can see here, the stock kind of hung around for a while, a little bit to the downside, and then ultimately, the last 10 days on this chart, going from $2 to 22 cents. So losing about 90% of its the price of the stock within just a few days, as well as losing 58%, if you guys can see that here, losing 58% of its value in one day. Now, there's a couple of really interesting things to talk about here. The first is, obviously, this is what a falling knife looks like in a stock. It is just one way directional, but it gets hammered one way. So it goes straight down. There's a ton of momentum going on in the stock, and all that momentum is focused on to the downside. So people are selling like crazy, and there are very few people willing to step in and buy the stock at a higher price than people are willing to sell at. Thus, we see a ton of selling pressure, and then ultimately following that is a much lower price. So again, in the span of about 2 weeks, this stock went from $2 to 22 cents. This is what a falling knife looks like. Plain and clear. This is what a falling knife looks like. Now, what's very interesting is this stock, SunEdison, is what is called a hedge fund hotel. So what happens in the hedge fund industry is, and what you guys will start to learn the more you're involved in the market, the more you watch videos on this channel, and my market heroes know that hedge funders, money managers, they rarely know more than you and I. They might have been investing longer than you and I. They might have went to school for this. They might work at a hedge fund, but they very rarely know more than you and I do in terms of what to do with the stock. SunEdison was a hedge fund hotel. A hedge fund hotel is a stock that is predominantly held by hedge funds, and hedge funds buy the stock solely for the reason that other hedge funds also own the stock as well. So it's not like they go out there, they do their own research and figure out that SunEdison is a great stock. It's solely end up becoming shareholders solely for the fact that other people also held the stock. Other hedge funds also held the stock. And what they call it as a hedge fund hotel is because hedge funds park their money there. They keep it there for no rhyme or reason. So it's very interesting to look at this. This was a falling knife that went bankrupt, and the losers on this deal were hedge funds predominantly. So it's kind of an interesting thing. So again, this is what a falling knife looks like. Down hard. Down very hard in a short amount of time. And we'll put that into context here a little bit later. So about falling knives, what do the pros say about falling knives? I'm kind of like buttering you guys up here. What do the pros say? Well, Warren Buffett says one of the things that's kept me in the game is never catching a falling knife with a stock. Warren Buffett believes you should not catch a falling knife. Jack Bogle, who was the founder and chairman of Vanguard. Vanguard is the largest fund in the world. Actually, it's many funds. Vanguard has well over $1 trillion under management. So if you work for a company that has an employer-sponsored 401k, it is very likely, like 99% likely, that your 401k is invested with this man, Jack Bogle, in one of his Vanguard funds. So what he says, and this guy, obviously, just like Warren Buffett, is a big-time billionaire. If a stock is falling like a falling knife, it is dangerous and it is moving the way it is for a reason. So again, another billionaire, another big-time investor who does not believe that catching a falling knife is a good idea. And then Jim Cramer, host of Mad Money on CNBC, a world-renowned entertainer in the financial media space, says, don't catch a falling knife. So if the professionals, the billionaires, the money managers, the big-time entertainers in the financial sector are saying, do not catch a falling knife. Now, the reality is, we could take their word for it and just, if we see a falling knife, we do nothing. But what you'll start to notice, if this is the first video of mine you're watching, or if you've never been privy to any of my content that's out there, if you don't know any of my market heroes, if you've never heard me talk before on stage at events, is I don't like to take what the investing professionals, what financial media says as gold. Right? What I like to do is I like to take what they have to say, and then I go in there and dig in and do my own research. A lot of people know, if you know anything about me, you'll know that one of my claims to fame and one of the reasons why I am noteworthy is the fact that I've taken my account from $8,000 to well into the millions. And the way I've been doing that was to be mimicking exactly what the top 1% of investors were doing. But I just didn't read what they were doing and just automatically copied it. I read what they were doing, figured out which ones actually worked based off of the numbers, put my own twist on them, and then was able to really, really excel. So don't just take what investors say, what the top professional money managers say, and just go ahead and copy it instantly. It's got to work first. All right? It's got to work first. So what creates a falling knife? Well, prices going down in one direction, obviously, as you guys saw with that chart. And not only that, but large losses in shares can be seen in a short amount of time. And it gives the feeling like the stock is in free fall. Like the stock is literally just moving in one direction to the downside and is barely going up at all. So stocks going down, barely pausing or going higher. They're just pretty much going down in free fall. And if you've ever been in that position, and I've been in that position plenty of times, it can be pretty intimidating. It can be pretty scary because you don't know. You almost sometimes you feel like this is just going to continue. There's so much negative bias, there's so much negative sentiment that it kind of feeds on itself and it builds on itself. And everything you read about a stock on the internet or see on videos is just so negative. Everyone's saying short this stock, sell this stock, get rid of it, it's going to get killed, etc., etc. And it becomes kind of scary because, again, it feels like it's literally there's no end in sight of this sell-off, that it's so negative. It's so negative that the stock could easily go to zero. We've all been there. I've been there plenty of times. I'm sure if you're watching this video and you've ever had any investments, you feel that. If you went through the flash crash of 2010 or the Asian sell-off in 2015, or if you went through any parts of 2008, 2009, the dot-com bubble, if you were around in the crash of 87, we've been there. So again, I don't necessarily just take what Warren Buffett says and just copy what he says. I don't just take what Jack Bogle or Jim Cramer says and just copy. I take what they say, I go in there, I see if the numbers tell the same story, and then I go ahead and utilize those strategies. So we want to figure out what the numbers say about this whole catching a falling knife thing. So in order to figure out how good or bad catching a falling knife is, because remember, the beginning of this video is how to invest like a pro. Should we catch a falling knife? So the pros know if we should or should not catch a falling knife, which again is kind of like free fall in a stock, right? The pros know. They know what to do. And in the next 5 minutes or so, you're going to know as well, and you're going to know how to capitalize on that opportunity. So in order to figure out how good or bad it is to catch a falling knife in stocks, we had to do a study to see what the resulting price movement looked like after a stock fell like a knife. So from 2000 to present, I'm recording this video at the end of 2017. So 17 plus years of data, depending on when you're watching this video. So in SPY, Apple, Microsoft, Gold, or ExxonMobil. So SPY is the S&P 500 Index ETF. So think about that as the S&P 500. Apple, currently the largest company in the world, a technology stock, a real market leader. Microsoft, one of the largest companies in the world, also a technology stock. GLD is the gold ETF. XOM is ExxonMobil, the largest oil producer in the world. So those 5 stocks, 2000 to present. So we caught a falling knife, right? And let's break that down into real context. And this way we could actually go look at the numbers and see what ended up happening here. So catching a falling knife to us is the stock is down 3, 5, 7, or 10% in the last 10 trading days. So we want to see how the stock reacts after catching a falling knife, which is defined by us down 3, 5, 7, or 10% plus in a 10-day trading period. And then we want to go see what they do after the fact. So we want to go look at the resulting price of the stock 10 days, 30 days, 90 days, or 1 year into the future. We believe this will give us a good understanding of, should we catch a falling knife Should we not catch a falling knife? If so, how far does the knife have to fall before we go ahead and step in there and try to catch it and hopefully don't bloody our hands? And then how far out should we hold the position if we go ahead and do it? Or should we just stay away forever? So what we've done is we've broken these down by the 5 individual stocks. Let's see what the numbers look like. Again, numbers don't lie. Numbers aren't emotional. Numbers are one of the very, very few and exact things in the stocks. In stocks, we have charts, we have balance sheets, we have Fibonacci, we have indicators, we have all these things that are not as exact and pure as price. Here in this study, we're just looking to see if stocks are down 3, 5, 7, or 10% plus in a 10-day period, are they up or down 10 days later, 30 days later, 90 days later, 365 days later, right? And that will give us a good understanding if we should catch a falling knife or not. Or should we stay away forever? Or should we wait till it's down 5%, et cetera, et cetera. So this will give us a really good understanding. It's not emotional, it's pure numbers. Let's see what they look like. So for SPY, what we see here is, and what's clear to me is, okay, catching a falling knife, anything more than 3% down in a 10-day period, the SPY or the S&P 500 is up 10, 30, 90 or 365 days later, more than half the time. And we see a very large jump when we go from 3% down to 10% down, all across the board in terms of how many days out we're looking. And we see a big jump again once we go from 5 to 7, and ultimately from 7 to 10. So clearly what we see here is the highest likelihood of the S&P 500 being up when we're catching a falling knife is after a 10% move to the downside in a 10-day period, looking out 10 days and 1 year. So that's pretty clear here. And obviously, the further time frame you go out in the S&P 500, the more likely it is to go higher, and the greater the sell-off or the greater the speed or size of the falling knife, the more likely it is to go higher. Very, very interesting. What about Apple? Apple looks somewhat similar to SPY, actually. Somewhat similar. It has a greater chance of being up after a 3% down move than SPY did. However, across the board, again, very, very similar. The further out our time frame is, 365 days, right? The further out our time frame is, the more likely Apple is to be higher after being down 3, 5, 7, or 10% in a 10-day period, as well as the greater the sell-off, the more likely it is to be higher 10, 30, 90, and 365 days in the future. Microsoft, very similar results. Very similar results. The further you get to the right of this chart, the greater the numbers. What does that say? After a 3, 5, 7, or 10+% sell-off in Microsoft, the further you look out, or the shorter you look out in the 10-day period, the greater chance Microsoft has of being higher. Again, this is over 17 plus years of data. It's a big sample size. As well as the greater the sell-off, the more likely prices will be higher than they will be continue to be lower. Gold, so not an equity. Gold, a commodity, right? A commodity is very much only likely to be higher after a 5% down move at the 365-day outlook or the 90-day outlook as well. But with gold, a commodity, really big down here. The bigger the sell-off, again, the bigger the sell-off, the more likely gold, a commodity, is to be higher 10, 30, 90, and 365 days later. And ExxonMobil, which is a stock, which is an equity, however, the price of ExxonMobil is very much tied to the price of oil, a commodity. Again, very similar results. The further out you look, the more likely the stock is of being higher. The greater the sell-off, the more likely the stock is of being higher. So again, ExxonMobil, after a 10% sell-off in 10 days, it is 95% to be positive 10 days later, and 93% positive to be 93% likely to be positive 365 days later. So you guys can see across the board, for the most part, the further out we look after a 3, 5, 7, and 10% sell-off, the more likely the stock is to be higher than it is to continue lower, as well as the greater the sell-off. Right? The greater the sell-off, we see a lot of 100% in terms of after a 10% sell-off in 10 days, the likelihood of a stock being higher than it is to continue lower. So what are the takeaways here? Well, obviously, guys, although Warren Buffett, Jack Bogle, Jim Cramer, they say don't catch a falling knife, I'm not entirely sure the context of what they were saying either. It could have been a lot of different things. However, based on the numbers, and based off of the definition that we put around catching a falling knife, or what a falling knife actually is, well, catching a falling knife works. Let's look at gold, for example. If gold over the last 17 plus years had a 10% sell-off in a 10-day period, there was an 100% chance that it was higher 10 days looking out. There was an 100% chance it was higher 365 days looking out. In Apple, if Apple was down greater than 7% in a 10-day period, there was an 89% chance that Apple was higher 30 days in the future. SPY, if SPY is down 5% in a 10-day period, there's a 72% chance SPY was higher 10 days in the future. So guys, numbers don't lie. Numbers don't lie, especially over such a big sample size like 17 plus years. Again, sample size is really big. This isn't curve fitting. In that 17 plus years, we saw a dot-com sell-off. We saw a move up until the 2008 recession. We saw a big-time recession from 2008 to 2009, and then we saw a bull market with a couple of flash crashes from 2009 to present, or depending on when you're watching this, to the end of 2017. So catching a falling knife, it works. The numbers say it works. So when a stock is down greater than 5% in a 10-day period, it is far more likely to go higher 10, 30, 90, and 365 days in the future. And again, where do we see that? Where do we see that? We see that with Microsoft. Look at this. Once we get to that down 10% in a 10-day period, it's much, much greater than that 3%. Apple, same thing. Over 80% once we get down into the 5%. And same thing with SPY, well over 70%. Right? So again, where are we with those takeaways? When a stock is down greater than 5%, and that's kind of the rule of thumb that I use and my market heroes use, when a stock is down greater than 5% in a 10-day period, it is far more likely to go higher 10, 30, 90, and 365 days in the future. However, if we want to do a little bit better, when a stock is down greater than 5% in a 10-day period, the days in the future that are most likely to see higher prices are 10 days and 365 days, which is kind of cool. And again, the numbers support that. Not my guess, not my beliefs, not what I read in some book or some article or I saw on TV. The numbers say that when stocks are down greater than 5% in a 10-day period, they are far more likely to go higher than they are to continue lower. And what's better is 10 days out and 365 days out are when they're even more likely to go higher than they are to continue lower. And as you guys saw with the numbers, the further the stock goes down in a 10-day period, the worse the sell-off. So the worse the speed of the falling knife, the more people consider it risky, the more people start talking about how nasty it is, the more articles you read about selling the stock, the more people on the street say, hey, you should sell the stock. Actually, the greater the chances that the stock stops selling off and goes higher 10, 30, 90, and 365 days in the future. I want you guys to think about that for a second. I'm going to pause here for a minute. I want you guys to marinate over that. The uglier things are, the more you read about how ugly they are, the more you hear people talking about how ugly they are, the more you see a stock sell off. the greater the chance that that sell-off is stopping. And in fact, not only that, but the greater the chance that the stock is going to go higher as opposed to continue lower over a 10, 30, 90, and 365-day period, and specifically even better on a 10-day period and a 365-day period. So a little bit of discussion. Why does this happen? Well, there's something called capitulation. There's something called capitulation. Now, capitulation is exhaustion, right? Let me repeat that. You might hear what capitulation is elsewhere in other financial media, other blogs, videos. Capitulation is exhaustion. Now, stocks, buyers and sellers get exhausted all the time. And you typically see changes in price movement after a large sell-off because sellers are exhausted, right? It's funny because a falling knife goes straight down, but the reality is price movements of publicly traded companies that are worth tens of billions of dollars cannot go straight down. Their fair value will not allow for that. The type of investors who are investing in some of these larger companies. We talked about SPY, Apple, Microsoft, Gold, and ExxonMobil. The likelihood that those stocks can sustain very, very fast, very, very large sell-offs, as you guys have seen, is very, very small. There are only so many buyers and sellers out there in the world. So these sellers get exhausted very, very quickly. And there's no other sellers to sell stocks at to sell any stock at lower prices. So what happens is they get capitulated. They get exhausted. And if no one is willing to sell at lower prices, the buyers will step in and start buying at higher prices. That's what allows this information that you see on the screen and that you saw in this information to have stocks that are far more likely to go higher than they are to continue going down, right? That's why you see that, because sellers, just like buyers when stocks go up, sellers when stocks go down, there's only so many sellers and there's only so many low prices that they're willing to sell their shares for, right? This creates capitulation and exhaustion. And that's why you see prices revert to the mean, go higher. Obviously, again, when stocks are down greater than 5% in a 10-day period, they are far more likely to go higher than they are to continue to go lower. Again, Microsoft, 70+%. Apple, 80%. SPY, 70+%. And again, as it gets worse, as the sell-off gets worse, they're even greater chance, they're even far more likely that they will to go higher than they are to continue lower. So again, it's because they're exhausted. It's because of something called capitulation. Now, my market heroes have a really cool little indicator, a little cool thing. So you guys, first of all, look at this chart here. There's no indicators. There's no squiggly lines. There's no Fibonacci. There's no MACD. All I have is a chart, and all I have is something up here called price change. And what this allows me to do is this allows me to see how much the price of the stock has moved in the last 10 trading days. So remember, anything over 5% in the last 10 trading days, we see that as an opportunity for the stock to go higher 10, 30, 90, and 365 days in the future. And the numbers support that. It is the stocks that are down greater than 5% in a 10-day period are far more likely to go higher than they are to continue lower. So what we see here is this is a little indicator that I give to my market heroes, and they're able to quickly see this. So let's try to find a stock. I actually don't know any. Let's try to find a stock that's down greater than 5% in a 10-day period. So EEM is not. That's down 3%. Let's do SLV. Perfect. SLV, silver, is currently down 7% in the last 10 trading days. It looks like a falling knife over here, does it not? Awesome. So this is an awesome opportunity to put on a trade that gives you potential upside, where you're bullish, where you make money if the stock goes up, it's 7% sell-off, which means that's even better chances, that's even greater chances that SLV will go higher than, say, a 5%. But again, 5% is our cutoff. So again, SLV, it looks like a falling knife. It's down 7% in the last 10 trading days, right? Our numbers support the fact that SLV is currently in a state where it's far more likely that it will go higher than it is that it will continue lower over a 10, 30, 90, and 365-day period. So this is an excellent opportunity to buy shares of SLV, trade options that give you long exposure, because the numbers say, for the most part, we have a 7 out of 10% chance that SLV will be higher in the future, 10, 30, 90, 365 days in the future, than it will be to continue lower. So this is some awesome stuff, guys. This is some actionable stuff. If you see stocks that are down, quote unquote down, that look like a falling knife, the worse it is, the uglier it looks, the better the chances are that the stock is not going to continue falling, that someone's going to catch it and it will go higher. So thank you guys for tuning in. Let me know if you guys have any questions below, and I'll see you guys in the next video.